Hey guys, this is how to master liquidity and market structure. After this video, you should be more than proficient in the subject matter, and you should be able to take these trades with a much higher win rate. That is my ultimate goal. So I'm going to take you through exactly how I thought of this setup, step by step. So step number one is that each one of these colors that you see on the screen, for me, that's an indicator of each session. So if you don't know, there are usually a few different sessions. I'll just do it in Eastern Standard Time as that's what my chart is on still. So this is the Asian session. That's going to be things like Tokyo, Hong Kong, etc. And then the green is going to be my European session where we have, London and Europe. And then this orange is where we typically have the most volatility because that is when New York is opening, as well as the overlap with Europe. The red is without Europe, so the volatility is typically lower. So it just so happens on this day that I was waiting until the New York session to trade. So when I come to the market, this candle right here is the 9:30 stock market open, which doesn't typically mean all that much on something like gold, but it is still typically when the New York markets fully kick in. So I'm usually trading after that kind of settles, which is for me usually at 9:45 all the way to 10:30 is when I look for an entry. On this particular day, I actually took this entry at 9:35, which is unlike me, and I did pay the price being in a bit of drawdown. So with all that said, the very first thing that I look at when I come to the market is the market structure. So what is my market structure? Well, we could throw something on like the line chart where we're making higher highs and establishing higher lows, right? So for a beginner, this is probably helpful. For me, I can see it on the candlestick chart. So we have lows formed here. We break the high over here. We're establishing a higher price, maintaining that higher price, making another higher price, and then coming back down, but still establishing a higher low. And then you could even count this as a higher high. So that's our market structure. So even though we have all of this selling momentum, it appears this is actually a counter trend trade, people that are in this trade, right? So why is that? Because we see that we're making higher highs and higher lows consistently over multiple sessions so far today. So this trade is not that likely to continue into a full reversal, right? So what we're going to do is look for the price to hold above the VWAP, which is this white line, the volume weighted average price, which it is, and the VWAP is also steadily increasing on this particular day, which indicates a little bit of bullishness, meaning it's going to go up. And so what we're looking for on our entry is step one, my time. So my time is going to be after the 9:30 open. And as we can see, the 9:30 open try to fake us out as if we're going to begin selling again. But we can clearly see that this large green candle comes into play on the very next 5-minute candle, which is what we call a bullish engulfing candle, because it fully engulfs the previous red candlestick. So when I see that, that's why I entered on this day, because I was like, oh, that's a bullish engulfing. That 9:30 candle was likely a fake out, and we will continue upward. So I already am set in stone from this moment that I want to take a long. So my long is pretty simple. I'm going to try to enter once it breaks this body, and let's say I got a little bit of lag on my entry, so my stop is going to be below that swing. And where is my take profit going to be? Well, for me, this is where the liquidity comes into play. So I like to target liquidity levels, but you might notice that my risk to reward is only 0.93, so I want higher than 1. So what am I targeting? I'm targeting each one of these white lines, but why? I'm doing it because at each one of these wicks, sellers are going to place their stop losses, right? Because that's where people are just more naturally inclined to put their stops. So their positions from the New York pre-market are going to look something like this, right? Where their stops are going to be above each one of these wicks. And some of these guys are holding it all the way until down here, right? And maybe they're getting greedy, or maybe they just have a longer type of trade, but they're expecting it to go all the way back down. So they're left holding the bag. So our job as the buyer is to ride the institutional buying pressure until we basically stop these guys out, because they are going against the overall trend that has been established by not just retail traders, right? So I'm going to look for profit taking in each one of these areas. Preferably, my first take profit would probably be the second one because of how big my stop loss had to be on this day. So as you can see, we get in a bit of heat to start things off, which kind of goes back to why I don't trade that early in the session. And then right here, you can see literally 10 a.m., we get a nice doji candle signaling imbalance. Then we get that reversal pattern, and that continuation kind of holds. So we ride that up until at least this second level here where we know that there are stops resting above. And a bit of choppiness, but we're still holding that moving average, wigging off of it, which is nice, the moving average being the red line. And we can see that in this move, we're actually able to capture all three of my first take profit levels, right? And so what we want to do as we're getting to each one of these levels is take some profit, take some size off, meaning let's sell some contracts, right? Profit taking, because something like this will happen sometimes. I know this is kind of an extreme example, but it is a very real one. I mean, this just happened on Friday, right? So let's say we wanted to hold all the way to our final level, right? And we're holding the entire size of our trade still. So it is a Friday, which isn't the most forgiving day of the week because there might not be that much news, and so it's a little more unpredictable, etc. So we see that yes, our first three take profit levels are hit where the liquidity is, but oh, certainly it'll go right to that last level, right? Well, no, we actually see in a matter of 5 minutes, right, on this candle, in a matter of 5 minutes, we gave back almost all of our profit, and then in a matter of 10 minutes, we're all the way back in drawdown, which we haven't seen since like 9:50, and it is now 10:35. So all of this profit gone in a flash of 10 minutes. Now, lucky for us, it actually has a nice reversal pattern over the next 10 minutes where we have this hammer candle, which is quite nice, and then we have this bullish momentum candle breaking the high of that reversal doji. So that's quite nice to see, and then we could just basically write it out from here. So I would have, if I went through all this drawdown, I'm holding it until this last TP level. Like, that's just how it is. I actually did get out up here, but if you did want to hold it to the last TP level, I would, at this point, once you see this reversal kind of signal, I would just continue the trade and write it out and hope for the best. So it does take a while. We get all the way back and draw down a little bit. It does grind up over a long time, but it gets there. And that's the point that I'm trying to make, is that liquidity is kind of a magnet for these instruments. And then another thing you could do at this point, if you want kind of like your get back on the market, is you could hold a runner. So you get out most of your position at this point so you don't make the same mistake twice. And then maybe leave like one contract or something on just to see if you can get a little extra, pebble or two of money. And we ride this out on the moving average. I use the 9 SMA, which is this red line. And basically you're holding until you get like one or two candles to close beneath the red line. So you can see that these are basically closing on it. So usually I want to look for it to kind of close actually below it, So this is kind of the first candle up here to close below it. And then this is the second candle to close below it. So basically if I followed my rules for a runner, this isn't the full size, of course, but the runner would have been able to go up until this point, which is quite a significant trade. Again, our stop was quite long, or wide, but it's still a 1 to 3 points to 2. Now, of course, you could have scaled in as the trade continued to grind up if you were feeling, very risky, but I don't think it was a good enough setup to necessarily warrant a scale in. But yeah, this is how you would use a liquidity level. And you might be wondering what this green line is. This is actually a higher time frame liquidity level. That I have to go like all the way back here. I think it's actually on the 2-hour, and it's something like 4622. So I have to scroll all the way back, and I actually did this the day of, and you can see that right here on the 2-hour, because I was curious, like, okay, well, where would we be going? So sometimes I do have to scroll all the way back, and that's all I do. I look for the wick. I look for the liquidity level. Where could we possibly be going? So I was like, okay, here, right on this 2-hour wick, or this 2-hour wick here, or this 2-hour wick here. So if I mark all of these up, and then we go back to where we were, we can actually see that these are all key areas. And how cool is that? Not only did that 2-hour just tell me where the liquidity was resting on the 2-hour chart, but it also helps me out on the lower time frame, because we can see that we held. So we got that liquidity from that lower level, right, on the 2-hour chart, which is this red line now, the straight horizontal one. And then once we grabbed it, we retraced all the way back to that red line, and we actually held it. And how crazy is that? And then from there, I know we have a lot of lines on the screen now. From there, we go to that liquidity on the 2-hour, this green horizontal line. And then from there, we actually even hit this other level on the 2-hour that we just found. So sick to me how liquidity works in the market. I definitely think that that's the number one thing to learn, is to go to the left, like go back to the left, look for liquidity. And it doesn't matter, like sometimes it's so far to the left you might have to scale up the time frame like I did, because it's just that far back, right? So I hope this video helped you guys, and honestly, if you watch this again or just take notes on this, I guarantee you will be such a profitable trader. This took my trading to the next level for real, like absolutely. So I know it's a bit complicated, but thank you for tuning in, and I'll make more videos like this. Thanks.